Yo guys, it's John here with Option Lab. In this video, I'm going to show you how I'm going to make 5K this week on one stock with only 2 clicks. So if you guys are not familiar with who I am, let me quick show you. Last year in 2024, trading these strategies, I made roughly 2.2 million. I'll refresh my Schwab page so you guys can see that that's legit. You guys can also watch my other videos, but anyway. So if you guys are not familiar with who I am, I trade option premium selling strategies, and this video is going to be one of those. By the way, I appreciate all of the support you guys have been showing on my channel. I'm about to hit 100 subs. I've been talking to a ton of you guys who are trying to get into the small account challenge, messaging you guys literally all day. So again, the first 10 people to DM me from this video on Discord, small account challenge. So you click the link in the description and DM me that. I'm going to try to get you guys onboarded for this week's challenge. Just shoot me a message. Anyway, how am I going to do 5K a week on one stock with 2 clicks? The strategy is going to be selling naked strangles on MSTR. If you guys are not familiar with MSTR, the company owns, I think around 30% of the company is just in Bitcoin. So obviously very volatile. It's kind of like a pseudo way to trade Bitcoin if you're an options trader. And what I'm doing is I'm selling super far out of the money strangles. Hang on, let me minimize myself here. I'm selling far out of the money strangles on MSTR. So if you guys are not familiar, I'll briefly draw out and explain what a strangle is. So if we have a stock and it looks like that, the chart, I'm selling to open a naked put, and for doing so, collecting a premium. As long as that stock stays above my strike price by expiration, I keep my premium and I don't get any shares. Then on the top side, I'm selling to open a naked call and receiving a premium for doing so. And as long as that stock stays below my naked call strike price by expiration, I keep the premium. So what happens then is for a strangle, I have the stock, and as long as it stays within my range, between my 2 strike prices, I keep double the premium. So how can you turn this into a more small account friendly trade? You can, take your strangle and create them into spreads. And if you guys need help with this, just shoot me a message on Discord. This is something that's a little challenging at first, but basically adding a protective leg above your 2 options you're selling. So that turns it into a protected condor, requires much less capital, and allows you to kind of play the same strategy. Anyway, I'm choosing strike prices for this strangle that are under 20 delta, meaning that it's an 80% probability or more that the stock stays above or below that strike price by expiration. So let me show you what that looks like on the chart. So I took a screenshot of the option chain here, and I believe I went for the 252.5 strike. So let me zoom in here. So the 252.5 strike right here for January 17th, right now, if you look at this delta thing column, is a 0.07. That's a 93% likelihood that the stock stays above that strike price by the January 17th expiration. So for selling to open 10 of those, I'm collecting about $250 or 2 per contract. So that's $2,000 right there for a 93% probability trade. What am I going to do on the other side? Let's go to the calls. So I always have delta on my option chain. I emphasize that in all my videos. But anyway, if we look at the same delta on this end, let's go to, let's see which one I did. So the actual trade itself, there's the 252.5s. You can see there, 2,500. And then the 490s. Yeah, so I put in the 490s. Let me zoom in here. The 490s right now, that delta is, what is it, 0.7? Yeah, 0.08. So that's a 92% likelihood. So in reality, what you're looking at here is you have a stock, MSTR, that's moving like this, and you're choosing strike prices so far out of the money for your strangle that there's basically a 90% probability in either of these cases that it stays above or below your strike price. And you keep all that premium and can do it week after week. And that's exactly what I'm doing. So if you guys are not familiar, I track every single trade I take on a long spreadsheet. So if you are interested in seeing that, click the link in the description, hop in the small account challenge. I'll send you guys my trades if you ask. And yeah, that's the premise of the strategy. And briefly, I'll go over what happens in the case that it drops below or above my strike price. So in the case that it goes below my put strike price, I get assigned 100 shares. In this case, since I'm doing 10 contracts, that would be 1,000 shares. Now I own 1,000 shares of a stock that's down significantly, right? Because the market only predicted there to be a 7 to 8% chance that that happened. So now I own shares that I'm theoretically getting at a discount that I could then write calls and flip. Same thing on the upside. If I get assigned short shares, theoretically that stock is then very overextended, will likely retrace, and then I can flip those, even that they're short, I can flip them for a profit. And that's the exact plan. That is called the wheel strategy. And that is something I've been preaching in all my videos. If you guys want to learn more, like I said, link is in the description. Pop in the Discord. I've been talking to a bunch of you guys one-on-one. Anyway, that's a quick 5K this week. Let's see what happens. Peace.